Hogue here. Hey, Bowtie Nation, thank you for being here. Another great live stream Sunday, another beer money Sunday. So I've got mine. Hope you got yours, whether it's that adult beverage or whatever you're drinking there. I see a lot of the longtime citizens of the Bowtie Nation there in the chat. Thank you for being here again. Somalia, New England, Germany. Great to see everyone wherever you're coming at from the world. Let me know if you can hear me and see me all right there in the chat, and we're going to get started because, I love doing these live streams, just a way to kind of get a little bit informal, take off the bow tie, and just have a talk with you on these Sundays about some of these important topics. And I think that this week is something I've been thinking about for a long time. We've got some of the investment gurus, right, and the analysts, and actually some professionals that I respect a lot have been consistently wrong on a lot of investments. You've got Warren Buffett, for example, has called Bitcoin rat poison squared. Okay, Charlie Munger, his co-founder there, his confidant, right, called GameStop frenzy in January the dirtiest way to make money. Right, an analyst at JP Morgan has a sell rating on shares of Tesla with a $155 price target, which is 73% below even the recent sell-off, 73% below there. So what is it that, these smart investors, Warren Buffett is undeniably a great investor, very smart guy, savvy as far as financial analysis and investments. The analysts at JP Morgan, I know some of his other research, and he's a smart analyst. But why are they consistently wrong on so many of these types of investments, kind of the new economy type of investments, we'll call them. And it's something that I've been watching for a long time. I've even made the mistakes myself, looking at GameStop shares, looking at shares of Tesla in the past. And so I really wanted to get a better understanding of, what the experts have wrong about these types of investments. Some of these themes that we're seeing in the market over the last few years, and how you can use that to make more money. So. So definitely excited to bring that to you and kind of talk about these three. We're going to actually talk about the three types of investments. We're going to talk about what they've got wrong on shares of Tesla, some of the meme stocks like GameStop, as well as Bitcoin, and how to apply that in other investments as well. So we're going to get started. I see a lot of great citizens of the Bowtie Nation there in the chat. Thank you for being here. Switzerland, that's awesome. LA, Everybody out there love being able to connect with you on a little bit closer, personal, face-to-face level here on Sundays. Before we get started, I do want to invite you to get a free report. I've teamed up with the Motley Fool for a short-term campaign here on sharing some of the stocks that I'm really watching over the next 10 or 20 years. Right? We just got done with our big ideas, our Ark Invest Big Ideas report, kind of covering those biggest, those massive forces over the next 10 or 20 years, like AI, digitization, things like that, self-driving cars and electrification, and the stocks that are going to benefit. But I realized I didn't do a single video on all, the ones that are benefiting from the majority of those, right? So I wanted to do this report, teamed up with Motley Fool to be able to bring it to you. I've actually left a link to that in the chat above. Go ahead and click through there. You can download that free report. It's completely free. Motley Fool is going to send you a few emails, but you're under no obligation. You don't need to sign up for anything. You don't need to pay for anything. It's a free report, just something that I wanted to release to show you those top 5 stocks, actually the biggest 5 stocks in my portfolio, my own portfolio, the biggest 5 positions, and the ones that really benefit from more than one of those big ideas. So click through there, look in for the link in the video description below. I'll post it down there as well. Again, totally free report, no obligation, just something I wanted to put together there. So we'll cover these. So we'll cover the things that the investor or the professionals have wrong about these investments. Then we're going to get to Q&A, right? Real quick, last week's videos. posted one that I've been putting together for a while. Actually looked at the average retail investor's portfolio, so a small investor's portfolio, $100, right around there, $100, $500, $1,000 portfolios, and compared that to the $1 million portfolio. We did that on Friday, and I think a lot of people are really surprised about what's actually in the millionaire's portfolio, that actual millionaire's portfolio. We got data from Scorpio Wealth Partners and BNP Management for those portfolios. So a great insight into, kind of the difference between regular investors portfolios and millionaires portfolios, and how to kind of get the best of both worlds. So check that out. That's Friday's video there. This week we've got coming up tomorrow is how to invest smaller amounts of money. I know it's hard sometimes to get the budget to come out and get the money to invest every month. So I wanted to show people how to invest, as little as $1 a day. Actually, we've got an example in there how to invest $1 a day and grow that over 20 or 30 years, and be able to how to be able to do that. Also going to be talking about some highest return monthly dividend stocks this week on Wednesday. We've covered some of the highest paying stocks. We've also covered some of the highest cash flow stocks. Now I wanted to talk about the highest return stocks, because it's a really important concept that I think a lot of investors overlook or they neglect, because they're either going for that highest cash flow, those highest yields, but they kind of forget about the share price return and other forms of return. So I wanted to cover that, and that's coming to you on Wednesday. But let's get to this. Let's get to this idea here, because again, this is something I've been following for a long time. Ever since Tesla, shares of Tesla came up, and you can track it back to before that, but I think it's really taken off with Tesla that analysts just don't understand, right? They have these price targets for Tesla and these other growth stocks, and consistently sell recommendations or lower price targets, and yet the stock just keeps on booming, right? And this is one of the mistakes that I made as well, just looking at Tesla on that pure valuation standard, that kind of old school valuation stock analysis, and seeing, how can you justify a stock paying 1,000 times price to earnings, or in the hundreds of times price to sales, compared to especially so Tesla is a good example. Some of the legacy automakers trading for maybe 10 times on a price to earnings basis, 15 times on a price to earnings basis, and then you've got Tesla trading for 500, 1,000 times price to earnings. How do you justify that, right? And it's really hard to recommend shares of Tesla when it's trading at that level. But there is one thing that I think that fundamental analysis misses on shares of Tesla and a lot of these other things that we'll be talking about. Again, like we said, we're talking about Bitcoin, that Warren Buffett has called rat poison squared. A lot of, especially as the price of Bitcoin comes down, you get a lot of hedge funds, a lot of portfolio managers, a lot of institutional investors with the courage. They don't quite have the courage to do it when the price is up, because they look like idiots. But as the price comes down, then they all of a sudden find the courage to say, this is worthless. We told you so. There's nothing behind the value of Bitcoin or some of these other cryptos. So it's a little pathetic, really, that they only find the courage when the price comes down, and they're able to kind of reason that. But you've got the Bitcoin deniers, the naysayers, the meme stocks with GameStop and things like that. They're almost universally hated by these traditional investment gurus, these analysts, right? And yet there's undeniable that people are making money in these. Even after the drop, I think Bitcoin made another drop over the weekend here, as well as Ethereum and a lot of those other cryptocurrencies. Ethereum is down to under $2,000 each. Bitcoin is right around 33,000 last I checked today. And even after that sell-off, about half of where the recent peak was, long-term investors are still up 300% over like the last year. Tripling their money over the last year. That is unheard of in any kind of investments, really. And over the last 10 years, since before 2017, Bitcoin investors are millionaires, basically, right? These meme stocks. GameStop was trading at something like $4 a share, just as recently as last year, right? And now, even after it's come down from, it was up to $400 a share, it's come down to something like $180 a share. Even at $180 a share, that is 25 cents. I mean, that is an amazing return. Okay, so it's undeniable that there is money being made on these. So why are they so universally hated by all these traditional gurus, these analysts, these experts, so-called experts in the market? And so I want to cover these. And I think first of all, a lot of this comes from just where those traditional those investment analysts, the experts, the old school analysts come from, right? And how they analyze a stock. Okay, traditionally investments have exclusively been valued on a present value of future cash flows, right? So I want to bring up this because you all know I'm the math nerd in the house here. This is just the discounted cash flows formula, okay, the DCF formula, and this is traditionally how stocks are valued, right, by traditional stock analysts and experts. And what it says basically here is, and this is something we've been talking about over the last couple of months with that rising interest rate environment, is stocks are the present value of stocks. So what a stock is worth right now is the discounted future cash flows. It's the cash flows in the future that you can expect from that stock, or that you can estimate discounted into what it's worth today. Okay, so you've got the different years here: CF1, CF2, CF3. These are all annual years of cash flow, right? So you take a stock like Tesla. An analyst would take a stock like Tesla, and back in my old analyst days, I would do a cash flow model. Right, and I would say, okay, you know what? Where are Tesla's cash flows coming from? What are the projections for sales? What are the projections for profitability? That kind of thing. And I would build out cash flows for every single year out to 5, maybe even as long as 7 or 10 years. Usually right around 3 to 5 years, I would build out those cash flows, and then for each year, I would discount it by an interest rate. Right, and there's different interest rates you can use. But the fact is, it's just an interest rate. As interest rates go up, this number becomes higher, and you discount each of those years by that interest rate to find the present value, right? To find what those future cash flows are worth today. Okay. And we won't go too far into the math here. I want to, but I'm not going to bore you with the math. But the idea here is that gives you a fair value of which to compare the market value of the shares and decide whether it's a good deal or not, right? So you've got these, you've got that traditional analysis on stocks that is completely based on that formula. It's a formulaic mathematical formula that tells you basically how much a stock is worth, right? And I think there's a lot of other factors that go into, how much some of these stocks are worth. That Bitcoin, Tesla, meme stocks, things like that. Some things that you can't measure with this mathematical formula. And that's where these investment gurus, these experts and these analysts are going wrong. So I want to cover each of these three and kind of show you, what factor in these is causing these analysts to be wrong, and how to use that in your investments. Okay, and we'll start off with meme stocks here. So you've got GameStop, you've got AMC to a point, you've got I think Naked was even a meme stock there for a little while. And what you had is just a huge rush of retail investors, regular Main Street investors rushing into these, pushing the stock price up. And of course, that created a squeeze, a short squeeze, right? These stocks were universally hated by analysts, by hedge funds. They were shorted. I think at one point the GameStop shares were more than 100% shorted by hedge funds, so betting against those shares. And so what happened, obviously, with, when all that money came in on the long side to buy those shares, pushed the price up, the short sellers got squeezed out and really had to run for cover. Okay. But the price really, if you're only going off that traditional equity analysis, right, that discounted cash flow, these shares were dog shit. Okay, honestly, you can't. It's hard to deny that GameStop is worth 20, 30, 40 billion dollars, right? It's been losing sales every year for multiple years. The business model that it's in is pretty much dead, and it has to. Now it's kind of confronted with having to reposition in a new market, in those digital sales, in a digital market, and really keep up those sales. So if you're only going on that discounted cash flow model, that traditional stock analysis model, then there was no reason why the shares should go up that high, or even where they are now. But what the short sellers don't see, I think, and what the traditional analysts aren't seeing here, is this new power of retail investors and kind of that social media collaboration, right? Retail investors were able to actually collaborate. And yeah, I mean, some people in the SEC are talking about how it's kind of market manipulation, but not so much. It's really hard to litigate, really hard to prosecute. But they've been able to really band together and push these meme stocks higher. And when I was thinking about this is uncannily similar to how George Soros broke the Bank of England back in 1992. And I know there's a lot of people that hate George Soros out there, think all kinds of conspiracy theories about him. We won't get into that, but I want to do this example because this is extremely similar to what he did back in 1992 and made more than $1 billion on that trade, and what retail investors are able to do now, and why I think a lot of these experts are wrong in those meme stocks, those social media driven stocks like this. Okay. So if you don't know the story here, back in 1992 or back in 1979, right, an exchange rate was set for a lot of the European currencies, right? This was before they moved to the euro, the common currency in the European Union. So they set an exchange rate, right? So that they fixed each currency's exchange rate in relation to each other, right? So if the German Deutschmark went up, then the franc had to go up too. Right? That was just to set these currencies together. The problem was, England had inflation as high as like 13% right here, and just unsustainable growth, right? So when you have high inflation in your country and growth that's probably going to come down, then your currency is going to weaken. You're going to get a fall in your currency value versus some of these other countries, right? If you've got 13% inflation, your currency, the pound in this case, just isn't worth as much as the Deutschmark that doesn't have that inflation. Okay, so that's going to typically devalue a currency. But because they had this setup, these fixed rates, where each country said, okay, you know what, we will support our currencies so they're pretty much say in the same range versus each other. So they're pretty much valued the same as each other. The problem with this is when you get a really weak currency, the pound that had that 13% inflation in England, over those years, the Bank of England actually has to spend massive amounts of money to prop up that currency, to keep that exchange rate, right? And I mean, unless you're economics nerds like myself, then this is probably boring you. So I'm going to move through the story real quick, but. So you've got the Bank of England, right, the central bank spending massive amounts of money just to support the value of the pound versus these other currencies, right? So they're buying the pound, buying up as much as they can to boost that demand, so the value is higher and they can stay in that exchange rate. Now, most stories here credit Soros with pretty much single-handedly breaking the bank. Okay, the George Soros was the guy that broke the Bank of England, made $1 billion on the trade. The story goes that he bet so much shorting the pound, right? So when he's shorting it, he's borrowing it to sell it onto the market. So that increases the supply on the market. It really floods the market with that supply of pounds, right? So he's borrowing from banks, he's borrowing from hedge funds, he's borrowing money wherever he can find it to sell the pound into the market. But since the Bank of England had to keep that price in the range, it was forced to buy up that pound. As much as he was selling, they had to buy it, right, to keep the value up, right? Because if you got one person just selling billions and billions of dollars of something, then it's going to drive the price down, right? Because there just isn't enough investors there willing to buy everything he's selling. Right? Well, the Bank of England had to buy it. They were forced to buy it, forced to spend, hundreds of billions of dollars to buy it, right? And of course, it just bankrupted the Bank of England, right? They were spending so much money to buy up all these pounds that Soros was shorting that they couldn't do it forever, So eventually they had to devalue the pound. It meant Soros's short position paid off to the tune of over $1 billion. But it's really not true. And this story really has a lot to do with what we saw with GameStop and those meme stocks in January. Soros actually had a team he had actually teamed up with his partner, Stan Druckenmiller, which is also a very famous hedge fund manager right now. Robert Johnson of Bankers Trust helped them out. Bankers Trust underwrote a lot of these loans. So they were borrowing money from Bankers Trust, from a lot of other hedge funds, a lot of other hedge fund managers and institutions. And, they underwrote it. And of course, once Bankers Trust and all these other hedge fund managers and institutionals, institutions like Bruce Kovner of Caxton, the fixed income trading desk at Morgan Stanley, and Paul Tudor Jones were all in on this, right? As soon as they got word that Soros and Druckenmiller were borrowing to short and really teaming up against the Bank of England, then everybody just came in, like a flood. So you got not just Soros, but this team, really all around the world, all these billionaires and these institutional investors, these banks, everyone was just teaming up to borrow, short the pound, sell the pound into the market, and make the Bank of England really bankrupt. Okay, and so this is really the power. I've got a chart here of the pound, and you can really see what happened here. This is up here. The pound was pretty well trading in that fixed exchange rate, and then this Black Monday happened, right? Black Monday in 1992, where the Bank of England just had to say enough. We can't spend any more money to prop up the pound, right? And it was forced out of that exchange rate mechanism. The pound devalued, down from $1.40, right? All the way down to $1.22, so massive devaluation, and made all these trades pay off. And this is really the power of the retail investor that they have now. Back then, obviously, Soros, Druckenmiller, all these guys, they had to get together on phone. They had to get together, this was even really before email so much, but they had to band together socially to do this. Now, retail investors, regular Main Street investors, can do this all through social media instantly around the world, right? And that's something that I think hedge funds need to start understanding, and they've started to understand it. But retail investors, Main Street investors, now make up about 47% of trading volume lately. Okay, that's up from about a third just over the last years and historically. Okay, so imagine that, Main Street investors now control about half of the trading volume in the markets. Okay, and that is a much more powerful than what they've been in the past. And they're able to use these social media platforms like Reddit and Facebook and what have you to really drive these trades and team up against or for a specific stock. Okay, so I think this is really where this is really something you got to understand about investing now, is the power of the retail investor and the power to manage these trades. So you can't just go off of that discounted cash flow. You can't just go off that fundamental analysis. Okay, so that's one reason why a lot of these experts are getting it wrong. Why a lot of the hedge funds are getting it wrong. Now I want to cover Tesla, because this is kind of a different story here. Analysts are just now coming around to shares of Tesla over the past couple of years, giving up on their sell recommendations. In the past, and again, I'm no better. In the past, I've been, I haven't shorted Tesla, but I haven't recommended it either. I couldn't get myself to buy it because of that discounted cash flow model, or of that price to earnings comparison, right? I could not justify buying Tesla for something like 1,000 times on a price to earnings basis versus GM or Ford or some of these other companies, these legacy automakers, right? Because by traditional metrics, by that PE analysis, by that price to sales, the stock is terrifically expensive. Okay, even on this year's earnings estimate of $4.53 a share. Okay, Tesla is forecast by analysts to make $4.53 a share this year. The stock is still trading for 124 times earnings. And that's down from a peak of like 200 times earnings just earlier this year. Okay, while the market, so the S&P 500 trades closer to about 21 times forward earnings. You got Ford, GM, a lot of these legacy automakers trading closer to around 10 to 15 times earnings. Maybe some a little bit higher after the boost just recently. But 124 times earnings. How do you rationalize that? How do you justify that for a buy recommendation? But now, analysts are starting to come around and starting to issue those buy recommendations over the last few years. And I think it's really just kind of a bandwagon for a lot of them because they still don't understand the real value behind shares of Tesla and some of the stocks like Tesla and why it has this valuation, right? So what analysts don't realize, what they don't know, and what they're not able to factor in. Frankly, it's not so much a matter of not knowing what is happening here with shares of Tesla, but not knowing how to factor it into their investment is a kind of a new kind of social capital, right? Around some of these companies, around some of these investments, an additional value beyond just what you can measure with those cash flows, right? Now, sticking with Tesla here, you've got Elon Musk. You love him or you hate him, but even the haters, you have to admit he's a visionary and he is a genius. I can't stand the guy on a personal level, honestly. I can't stand, how he treats other people and a lot of, how he tweets at the drop of a hat. But it doesn't fit my traditional model of what a CEO is supposed to be. But again, he is a genius and he's able to manage that company. But the fact is that there are so many investors out there that put him on a pedestal and all this kind of creates a halo effect for the company. It becomes a valuation bump that rationalizes a higher price multiple for Tesla. Okay, in the past we've also seen this with like Warren Buffett and shares of Berkshire. We've also seen it with Jack Welch when he was at GE, at General Electric. Not nearly to the extent of Elon Musk and Tesla, but I think it's a very real factor that you as an investor need to be able to kind of factor into your analysis of a stock. How much you think a stock is worth and what you're willing to pay for that stock. Okay, because if you're waiting for shares of Tesla to get down to a price to earnings comparable with with traditional legacy automakers or the market or anything like that, you're never going to buy the shares. It is just never going to get down to that point because it's always going to have this valuation upside on kind of that social capital that Elon Musk has with the company. Okay, and you've got a lot of other shares like that. Just think of any company where where you've got that founder or the CEO that is just larger than life. He or she has that investor followership. I think Cathie Wood is another great example of this. Okay. Ark Invest has been around for years, for decades. In fact, we can bring up a stock chart of the Ark Invest funds, and you can look at how long these have really been around, and that I think the effect of that social capital that she's been able to to manage. Okay, so let's if you go to the Ark Innovation Fund, that's that main disruptive innovation fund. You go to Max here, and you can see, this fund has been around since 2014. So almost a decade even. It did well, through 2018, even up into 2019 from. So what do we got here? From about $20 a share to about almost 60 in as recently as February of last year. So threefold over about 6 years. Not bad. It's a very strong investment return, but obviously nothing like we've seen over this last year. And right here, just besides the value of the companies that they're investing in, I think a lot of this has to do with that social capital that Cathie Wood has with investors. It's starting to drain off a little bit here as the shares have fallen and as people start kind of questioning the genius and the rational and the decision making behind some of this, but she still has very much that social capital that people give her as an influencer, right? And so again, this is something I think you need to understand if you're analyzing some of these stocks. Analyzing these stocks like Tesla, like Ark Innovation, these stocks that have this larger than life leader that maybe deserves a little bit of a valuation bump beyond just those simple PE ratios and the discounted cash flow and things like that. Okay, I want to cover one more here with Bitcoin, and then we'll get to the questions and answers on this. So Bitcoin is another great example. Okay, like we said, Buffett has called Bitcoin a worthless delusion. His words. He's called it rat poison squared. And it's pretty strong words for a guy that's usually super reserved. And the hatred for crypto by that old class of wealth and managers is pretty prevalent. It's pretty pervasive. It's less easily defined than some of these others, and it really just seems to be kind of a refusal or an inability to accept that innovation can really create something that only governments could create in the past, right? So, in the past, it's only been governments that could create fiat currencies. We haven't seen a new asset class in, hundreds of years, right? Gold, so asset classes, gold, commodities, you've got real estate, you've got stocks, you've got bonds. We haven't seen a new asset class in so long. Hundreds, even longer, hundreds of years or even longer. So that traditional old school of wealth managers and institutional investors and things like that, it's really hard for them to accept that a new asset can just be created, right? They say crypto has no value, that you can't spend it, it produces no cash flows, which is true. Right now it's very hard to spend your Bitcoin on anything other than transferring it into cash, things like that. It doesn't produce any cash flows. But there's a lot of investments like that are really subjective. Their value is subjective on that worth, right? Gold is really the most obvious example. Just about everything you can say about Bitcoin, you can pretty much say it about gold, right? Gold has no value other than what people say it has, right? What people are willing to pay for it. It's, if you really look at gold, it's just a rock you pull out of the ground, right? It pays no cash flows. You can invest in the miners, the gold miners, and they're going to pay out a dividend and stuff like that. But gold itself pays out no cash flows. It's used in some industrial uses, but really the most value here is only because we say it has value. You've got a lot of other art and some collectibles, right? Are another example. Leonardo da Vinci's Salvator Mundi sold for $450 million in 2017. Okay, a picture of his representation, his portrait of Christ. $450 million for a painting, basically just oils on a canvas, just because someone was willing to pay that much. Okay, so it's really, this subjectiveness of things, of investments. But there is, a few things that really do give Bitcoin and other cryptocurrencies values beyond that purely subjective value. Okay, so yes, it does have that subjective value of, hey, it's this value because someone is willing to pay me for that. But it does have some other values. Some of the things we've been talking about on the channel, that network effect. Any platform, any company that runs on a network effect, these social media stocks, Facebook, Twitter, LinkedIn is owned by Microsoft, but Pinterest. Their value is basically the network of users, okay? The network of users that they're monthly active users that use the sites every month. And Bitcoin is the same way. You can actually measure, and we've done this in our videos, you can measure the value of Bitcoin based on that network effect. That Metcalfe's law is the mathematical formula we use for that to really get a fair value of Bitcoin based on the network of users using it. We hit about 900,000 unique addresses on the Bitcoin platform this year. It's since fallen to about 600,000, in this recent sell-off. But it is an undeniable trend higher. And as that network of users grows, then there will be more value there in that. Bitcoin. Tesla just recently said it wasn't going to accept Bitcoin as payment, but the trend there is to accepting more Bitcoin and some of these other cryptocurrencies as payment. I think maybe it's going to take some innovation for these. Tesla said, Elon Musk said they weren't going to accept Bitcoin as payment because of the environmental effects. Honestly, I think that's bullshit. Okay, because if you look at the truth here. Bitcoin mining, all the Bitcoin mining, there's actually I think it's about 47% of Bitcoin mining is done by renewable energy sources. Okay, so half of Bitcoin mining is already on renewable energy sources. Okay, and it's growing. So it's not necessarily that, all this energy, all the electricity used in Bitcoin mining is all fossil fuels and that kind of thing, right? So it's not necessarily that. And, it is growing. Do they need to do more? Yes, Bitcoin miners do need to do more to lower their carbon footprint, all that kind of stuff. But it's not necessarily that. I think the real reason why Tesla stopped accepting Bitcoin as payment is because, a lot of you, if you've read in the fine print of Tesla's agreement with purchases in Bitcoin, is really kind of shady the way they were doing it. Okay. And I mean, I'm not saying anything about Tesla and all this. I'm just saying the way they set this up was really kind of a shitty deal for investors. Okay. Or for buyers, because what they said, when they were accepting Bitcoin as payment, if you pay for your car, your Tesla, that's going to be delivered in 3 months, right? If you pre-order your Tesla with Bitcoin, then they take, whatever the Bitcoin is worth right then, and you pay it, right? So you pay $40,000 in Bitcoin for a $40,000 Tesla. Well, in 3 months from now, when that Tesla is delivered, if the price of Bitcoin has fallen, so now that Bitcoin that you deposited into your account to pay for that Tesla, if that's now worth only 30,000, you got to make up that difference. These were in the fine print, in the terms of agreement with Tesla for buying Bitcoin, for buying Teslas with Bitcoin. You had to make up that difference when the time came to deliver your Tesla. But, and here's the real shit kicker right here, if the price of Bitcoin increased, over that time. So now let's say instead, if the value of Bitcoin increased to where that 40,000 deposit that you made in Bitcoin, if that's now worth 50,000 when that $40,000 Tesla was delivered, Tesla gets to keep the difference, right? So it was kind of a win-win situation for Tesla in these Bitcoin payments, and I think it was starting to create a lot of social blowback for Tesla. A lot of people were seeing this in the terms, they were speaking out against it. And so the company just said, okay, just a minute, come on, we're not quite ready for this, to do this. If Tesla, if the shares of, or if Bitcoin fell like it's doing now, they weren't ready to go back to buyers and say, hey, sorry about your luck, but you owe us another $15,000 or $20,000, for this Tesla that you thought you paid for in the past. It was a real reputational risk for Tesla. So I think that's really the real reason why they stopped accepting Bitcoin for shares of, or for Tesla, for Tesla cars, But anyway, I think it is slowly becoming some form of a payment. It's obviously going to have to be a point of sale kind of thing. You can't deposit Bitcoin and for a sale in the future like Tesla was doing, because you've got that huge risk of of the value of Bitcoin. But that's something that's going to help give it some kind of a value. On the application side, this is the biggest thing I'm looking at for crypto, and why I've got a little more than half of my crypto in Ethereum rather than Bitcoin. Okay, so I'm investing in Bitcoin and Ethereum, but most of it, I'd say more than half, is in Ethereum because the applications development. Okay, that decentralized finance, the use of the blockchain in business applications. Okay, that's being driven by the Ethereum platform. There are more than twice the number of developers, people developing these applications using cryptocurrencies. There are more than twice the number of developers on the Ethereum platform as there are on Bitcoin, right? So this just means, as we start using more blockchain applications, as we start using the blockchain in more decentralized finance, in more business applications, then more and more developers are going to be using Ethereum. They're going to build it on that platform, and that's really going to support the price. Okay, so again, long story short on this one, Bitcoin it's subjective. The value is subjective, but then a lot of things are. Hell, even even the dollar, even fiat currencies are really subjective. It's our faith and our faith in the government to be able to prop up those currencies, to be able to support the value of those currencies. So there is some subjective value there, but there's also some of these other values. And that's really what I think a lot of these old school investors, these, Charlie Munger and Warren Buffett and some of these other analysts just don't understand, is that yes, it's subjective, but the effect of millions and millions of investors giving it that kind of value is really what's going to support it, and why I think why I'm investing, and I think every investor should have some of their money in in some of these. So now I want to turn it over to the question